and some friends stay mainly in your pants. G'day, mate. Shall I throw a pip on the bobby for you? How you doing, huh? Well, let's get going. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that allows you to trade not just Forex, but everything else that'll make you happy. Energies, metals, indices, binary options. You love it, we love you. Let's get together, huh? Trading's risky, not appropriate for everyone. Your past performance, good or bad, is not indicative of future results. Never risk money you cannot afford to lose. Traders Way. Trade your way at Traders Way with Traders Wayne. Hoo-ha! So what's going on, my friend? It's 2 hours before equity open on Wall Street. Oh, where's my screen? Oh, wow, it's way over there. Hang on, sorry. There it is. Yeah, so what's going on? Hey, remember when you read the Aussie meeting minutes, the Reserve Bank of Australia meeting minutes 2 weeks ago? Remember when you downloaded that from the RBA website and you read that there was no real change in sentiment, no real arguments. There were some concerns, but nothing radical. And you became smart money on the Aussie dollar, and you said, you know what? There's no change coming out at the RBA at the next interest rate decision meeting. Sure enough, that was today, and they kept everything the same. And you probably felt really good because you did what smart money should do, and you were informed because of your research. Isn't that nice? Congratulations. That's what we're driving at, isn't it? So that's good. So no real surprise there. In my opinion, we're still in this mode of rebalancing. So I don't care what you're reading on various websites and stuff, but what you should look at is, I believe we just have absolutely normal rebalancing preparation for all kinds of international risk, of course. But what's causing the international risk? And this is the funniest thing that I don't hear about. The international risk, things like volatility in China, has to do directly with the Fed. We know it's either September, October, or December that the Fed's going to raise interest rates, right? Isn't that a foregone conclusion? We don't know which one, but I would say somewhere between now and December 31st, they will adjust interest rates. How many people would agree with that? If you agree, say aye. Aye! I should do a motivational conference. Hallelujah. Yes. Well, Justina says, I don't think so still. Yeah, but the problem is Janet Yellen said she would, so she kind of has to, but whatever. But I think there's a high percentage, right? So this forces other economies, other central banks, to adjust their policy too, not because they love Janet Yellen, but because they have to do business globally with the US dollar. It's a reserve currency. And so, you know, it affects people. They got to do things, right? Okay, so, you know, I think it's okay. I mean, yeah, there's lots of volatility and stuff, but you know, I think we're just going through this period of, you know, we're sort of in the plateau. We went from a period of quantitative easing to no quantitative easing. Now we have to go to interest rate normalization, and that's all. And just things need to change, and things are changing. That's all. So cool. Right on. Right. Stay calm. Trade on. I think I said in the last video. So that's cool. And here we are looking at USD yen. And you see where it flipped? But we already had this lined up. Do you guys remember doing this? Probably Wednesday or something of last week. We had this all lined up, right? Down, up. What used to be support is now resistance. Cool. You sold it. Good, Justinas. 120 pips. Oh, well. That's a start, right? So it's just like the question is, you know, where do you start picking it up if you're a bull? And wow, you know, that's where you have to earn your money. All right, come on. You got to make some decisions, right? That's your alpha, so to speak. But cool. So here we are around 120. Very nice. Very nice. Very good. 120. Sounds nice. Nice round number. Cool. So let's take a look at how about some stock indices. Start the day. 97 pips. Special thanks to me. Well, anything for you, Demeter. Nice. So what's going on today in the UK? Generally speaking, kind of looks like a down day, doesn't it? So you could do things like fib, and you can do this because it's a trend, correct? So like in Asia, right, you can have it lined up like this, then it makes a new lower low, and you can adjust. Okay, big spike there. And here we are kind of in the 382. But in any sort of trend kind of mechanism, you go with, I like to eyeball the roll reversal area. And we're, you know, we're all kind of in there. And if you were a bear, this would be a nice little continuation area. It's not just the 382, right? So remember, I look at a couple of things. I look at the fib, and I look at this. The nice thing, if you were scalping, like this is an hourly chart, so you got like hours to be ready for this. But if you were scalping like on a 1 minute chart or a 5 minute chart, you know, I basically just sell in this kind of red zone here. Just boop, sell it, eyeball it, good enough. So we got ourselves a nice little continuation pattern, pretty easy, easy peasy lemon squeezy. That's in the UK. What about Germany? How did Germany do today? Today is going to be the day that I'm going to come back to you. Seems like another down day. By now, you should have somehow realized what you got to do. So we got stock indices in the UK and Germany. Well, what about France? What about the CAC? You're a CAC addict. Forget about it. You want to do the euro? All right, euro. Seems like a down day too. All right, so do you think this will have an effect on U.S. stock indices? Yeah, probably. How about Nikkei? Obviously, Asia opens things up for us, right? Look how hard it's been falling. Look at this. Bang, 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 bang. So what happens, like, let's talk about correlation here. What happens when the Nikkei in Japan falls? The yen gets strong, yo. Right? Yeah. Sell Nikkei, buy yen. Just like anything, when you're doing your analysis, you take the previous low. It used to be support. In future, it should be resistance, right? Oh, snap. Nice place to sell. So that means you buy yen. You like the yen? Why is that? All right. So Rod, what's the opposite of the stock market? When the stock market falls, what rises? What's the equal and opposite reaction? Okay. The bond market. No, gold. Poo-poo on gold. Come on. Yeah, stocks and bonds, guys. If the stock market goes up, the bond market falls. If the stock market goes down, the bond market goes up. Inversely correlated. So this is a function of risk, really, because when you buy the stock market, it's a lot riskier than the bond market because you're not guaranteed anything. In the bond market, at least you're guaranteed something, right? You're guaranteed your principal plus some income. You face other risks, and you face other risks, but you're guaranteed something, right? The stock market, you're not guaranteed anything, but because of that, if things go well and you get price appreciation, you have unlimited upside. Where a bond is, you get your bond, you get the coupon payments, and at the end you get your principal back, and that's that. Okay? So when the stock market's falling, that means people are getting out of riskier trades. In this case, it'd be the stock market. And they're going to buy something safe. That's JGBs, Japanese government bonds. Now, it's not just the Nikkei. If people are doing risk off, right? If they're looking for riskier assets like the stock market in Japan, they might also be looking at the stock market like, I don't know, in the United States of America. So what about these Japanese institutional investors that invested in places like the United States? And they decide today is a day to get out of risky investments. Well, what happens is they exit the US stock market and they bring their money home back to Japan and put it in something safe like a Japanese government bond. In that case, what happens is the stock market in the US falls, the US dollar gets weak, and the Japanese yen gets strong, and bond prices in JGBs, Japanese government bonds, go up, and interest rates fall. Hoo-ha! That's why. I see, master. Yeah, cool, huh? Yeah, and that's why you get like correlated markets. Now, the trickier part of the world, so if you've only been trading, let's say, for a few years, your sort of history that you think is normal is really incredibly abnormal. When a central bank is printing money, everything goes up. Well, that's really weird. You know, that's really weird. Or when we have a global financial crisis and everything's falling, that's really weird. And the correlation's too high. Like, I'll give you an example. There were a lot of mutual funds, for example, that said, oh, well, we're market neutral, or that we're diversified, for example. Oh, we're diversified. Well, what diversified means is you kind of move your money around to different, different sectors and industries, so that, like, let's say, if retail stocks fall because consumer spending falls, well, consumer spending is going to stay pretty stable for like companies that produce toothpaste, or let's say pesticides for farmers, right? That's not going to change, or that kind of stuff, right? Or healthcare companies, right? You're still going to pay for grandpa to be on his life support machine at the old folks home, despite retail spending falling. But what happened during the the recent financial crisis, everything fell regardless of what sector, and you were highly diversified, but systemic risk killed everything, right? A falling tide lowers all ships. And so we're kind of working our way back slowly to the new normal, but we're not talking about industries and sectors. We're talking about, global economies. So anyways, so guess what? I look at this and I think USD down, USD yen down. I used to have a charting package that you could overlap two things so you could see the correlation. I wish I could do that here. Today is going to be the day that I'm going to come back to you. All right, so no diggity, no Dow. You think it might be a down day today? Could be, rabbit, could be. Greg Anderson says he doesn't have JPY 225 cash. Come on, Gregers, open a TradersWay account. Then you can have what you need, bro. Join the Cool Kids Club. Mr. Anderson. Oh, you have 3 live accounts, right? Well, then how about this? What if you right-click and you highlight Show All? And it may just pop up. Okay. Winding. So that would be further US dollar weakness unless that central pivot point holds, right? Maybe it does. Right? So just eyeball it here. Maybe we get a 5-day cross up. Maybe what? It goes up, hits the 21. It's going to have to come down again. Weekly central pivot points defended a second time. Go up, hit the 55, come down, hit this old area, and go to the 200. This to be bullish, that's how you do it. And you can be bullish on this, guys, even though futures were way down and everything else globally fell. You were bull. You could plan it. You could say that. Right? Greg's been with TradersWay since 2014. Right on. So just be careful. Remember, don't fall prey to only recent price action. If you're a bull, at least prepare to be ready for it. Okay. And this is where you would hedge if you were a hedge fund manager. You're like, all right, this probably should go up. Let's say the stock market, right? This is the Dow, right? Let's say you're like, all right, I think we've bottomed out for the month, right? Let's say that was your thought. Then we made the higher high. This is the retracement, right? This is your 1, 2, 3 reversal pattern. You think we just bottomed out and we started September like this, but we're going to end September, right? October 1st, we're going to be higher than now. Let's say that's your decision. Would anybody agree with that? You've made your decision. You're like, September's we're gonna be October 1st. The stock market's going to be higher than right now, right? So then you need to like prepare and plan for that. And in the beginning, because we're not truly there yet, like we're almost to the 1, 2, 3, but it'd be nice if this went higher, right? If you're a bull, you'd be much happier with a higher high. So in this one, what you do is you'd look to go long. We're not quite ready for it yet. Close. It could be happening in the next couple of hours, right? So you look to go long, and then you hedge, and you say, well, if the stock market falls here, what will happen to like the US dollar, for example? Or you buy the cash and you sell the future to hedge, either way. S&P 500, same sort of thing. If you're a bull, you need to have a plan. And if you're a bear, you should have sold it already. Right? Right into your fib level, because you know obviously that's a fib, right? And then once you hit the fib level, it makes lower low, lower high. I mean, come on, dude, right? Doing something now on the short side would just be foolish. If you were going to short this, you'd have to wait for the retracement and then sell. What we're in is a buy zone. Even though this has fallen all night, we're in a buy zone. Okay, and again, it's because of the 1, 2, 3. Okay, 1 being the double bottom, 2 being a higher high, higher than this high, and 3 is the fib, right? So let's say that's about a 50% retracement, and the next move should be here if you're bull. If you understand, say I. I. If you're a pirate, say R. Arr. I'm a pip pirate. Arr. All right, so that's the stock market. All right, fine. Good. Let's go around the world. Around the world, around the world, around the world. All right, some USD kitty CAD. Okay. First, we got to look at this. All right. Is that a lower low? Around the world, around the world. So what you do is you drag this across and you look for something like boop, boop, somewhere in here. You know, you're going to look at fibs and psych levels and everything. I'm not doing that, but you should know. Around the world, around the world. Okay? That's what you'd be looking at if you're playing it as a range. I think the range is like, I guess you'd call it like that. Lately I had the strangest feeling. All right, something like that. That'd be some dollar weakness. US dollar weakness, I should say. Okay. Which the funny thing is would be pointing to a falling stock market today. Want to look at some big yen? The beast? All right. Seems like it's continuing down. So, central pivot point, central pivot point. Okay, you see that? So that means the market closed lower last week, and therefore the chances of the market continuing down are high. You should know that when the market opens Sunday night, Monday morning, whatever the case may be for you, and it's heading down. Does this mean risk on or risk off? What's happening here? Risk off. So money is leaving the UK, because this is the pound yen, and going to Japan. So what are they buying in Japan? Are they buying stocks in Japan or bonds in Japan? Are stocks risky assets or safe assets? Therefore, risk off. Stock market's down, bond market's up. Okay, so you see that when you sell the stock market. Oh, snap. How dare you, Emmanuel? Around the world, around the world. All right, so that's cool. How about our buddy Aussie? Well, the US dollar's weak, but Aussie is weaker. Hoo-ha! Or the dollar index for the USD, the Dixie, is starting to rise. One of the two. But anyways, are you a bull on the Aussie or a bear? Oh, I've been a bear for 3 years, I guess. Right? Cool. So it's just working its way down. Does any of this say buy? This is 3 years of trading. Where does it say buy? So yeah, guess what? Keep selling it. Yep. Cool. So yeah, this kitty cat is bouncing, this USD CAD, which is showing dollar strength. So it'd be very interesting if the stock market futures open down and then we rally this up, which I'm actually expecting because I'm still a stock market bull. But I understand that portfolios need to adjust. So I get it. So once we kind of get through that transition period, then stock market up. And of course, the big question mark that's affecting everything right now is, you know, are we 17 days away from the Fed raising interest rates? So some people need to hold their breath. Around the world, around the world. All right. So the euro dollar came down, 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 down. And where did it bottom out? The 76 Fibonacci retracement. And that the price action here is just a random walk. It came down 78.6% and then stabilized. Anybody think that's random? What a coincidence that is. So like for me, today is the first day of school. And the interesting thing about all this student and learning from academia, they're just flat out wrong. And how do you tell the professor, like, you're stupid? Do you actually believe that? Not an easy thing to say. You know, what do you know, Harvard? But random. There's no way you could possibly predict the stock market. I'm like, oh, okay. Right. And the value of a stock is the present value of all future dividend payments. Do you? That's so stupid. That's so stupid. But anyways, yeah, I don't believe that's random at all, of course. And I think if you understand it, you teach it differently. But there you go. Yeah, I suppose, Ron. But, you know, what do? You know, there's two things. I want to learn, but I also want to get I want to get an A. I was so mad to get an minus. I was just so upset. Can I tell you guys a quick story? With my children, I have discussions about ordinary, extraordinary. Like being extraordinary is expected in my family. Like extraordinary is just ordinary. And my daughter, which excels at language and writing and reading, math is a struggle. So about a week ago, she brings home a C on her report card on her or sorry on her math test, and I freaked out, just freaked out. A C is just so unacceptable. You know, if you screw up a test and you get a B, well, let's work on what you screwed up on. But a C means you were just not prepared. You didn't do your homework right, and wow, just freaked out. So I was supposed to take the kids that day to jump to the jumpy house, you know, where you go and they have all these blow up houses and you jump and you go down slides and you just running around like maniacs. I'm like, you're not going, but I'm taking your brother. You're staying home. No jumping for you. A C is just so unacceptable. There's just no way I'm taking you. And you're going to stay home and pick weeds in our flower garden for 2 hours while your brother goes to the jumpy. Guess what? She got tested a week later, brings home an A. Nice. Thumbs up. Yeah, C's are just too painful. So what are you going to do if you hit mediocrity? And this is where we've had long conversations in the past, so today won't be appropriate for it, but are you willing to sleep on your kitchen floor or in your bathtub because you made you just made a bunch of stupid trades today. Like you could have losing trades and not be stupid, but you know every once in a while you can make a bunch of stupid trades and you sit back and you're like, what the hell was that? Come on, Wayne, right? On days like that, are you willing to sleep in the bathtub? Which is our way to say, you know, no jumpy house, stay home, pick weeds, so that the next time you're tested, which is we get tested every day, right? That you're not going to screw up. You're not going to do anything stupid because you don't want to sleep in the bathtub again. Why negative reinforcement? No, it's not negative reinforcement because there's constantly positive reinforcement. We're a happy, loving family, right? But there's consequence. Mediocrity is completely unacceptable. So if the carrot doesn't work, which, you know, we're a carrot house, if the carrot doesn't work, then there's the stick. But the mule is going to move where I want it to move. Right? So it's not negative reinforcement, it's consequence. I didn't get the C, right? You spend 2 or 3 hours a night doing homework, and they're in 3rd grade. They get constant attention from mom to make, you know, they have all the resources they need, much more than an average kid. So you just can't bring home C's. That's it. So what are you going to do if you bring home a C performance, guys? What's your pain point? Now, look, the carrot in Forex is, you know, I don't know, personal freedom and money. So the carrot's already there, guys. So what are you going to do if you perform at a C level? Mediocrity, right? That's your best for the day. Mediocrity? You should freak out like a dad should. On yourself. And say, we're going to fix this. So. Cool. Yeah, the dollar is still trying to get strong. Could be a very interesting day. So this is where you need to make sure you're not chasing price around. If you're a bull, set it up. If you're a bear, make sure you're paying attention to what's happening. Right? So since the London Open, it has been down. It did make this little lower low. You know, see, it's not the greatest in the world, but all that kind of stuff. Notice the line going across. There is support in here. So if you're a bull, you should be preparing for what you want to do the rest of the day. Are there any requests for further technical analysis? Kiwi, yeah, I haven't covered Kiwi. Around the world. Okay, so there's an easy thing here. You have to decide if you're a bear, there's definite selling opportunities, or if you're a bull, you're definitely at support or near it, right? So that's all you need to make is that decision. That's that. So there's only two things you can do here. Okay, still in the sweet spot. or trade a bottom. If you're doing stuff in the middle, I mean, the only other thing you would do is this. So the bears are still selling on the top. Now, just in general, should you be setting up a bullish pattern here? Well, not really, huh? To me, you should just be selling this and selling this and selling this. And see, I look at this and there's just nothing bullish ever. There's just nowhere this is bullish. How do you discern whether the market is bullish or bearish? What's one easy way? No, the 200 EMA is fair market value. It's not necessarily bullish or bearish. It's just technically the 200 EMA is neutral. The 2155. Thank you, Alan. That's exactly right. Right here, the 21 drops below the 55. Technically, the market is bearish at that point. Technically, that's it. I don't discuss it any farther than that. It's just bearish right there. That's it. We're still bearish, and the 21 is in control. So I believe it's go down, up, so on and so forth. Because if you're below the 21, or actually what I mean is if the 21's in control, which it is in here, then you're bearish and aggressive. So that's all it is. The 21's above the 55, you're a bear. Done. But that's just the market, right? Market. It's right out of my book from 8 or 9 years ago. I don't know how long it's been. Market. Market is bearish. But we know even if the market is bearish, price action could be up in the moment. That's why they call it momentum. In the moment. Right now, like right here, price might be rising. That's fine. But the market is still falling. So wouldn't it be nice if you looked at price, which the momentum of price, I use the 5/8. So wouldn't it be nice if you lined up price action with the overall market forces? Another way of saying it is, I wonder what happens if I sell in a falling market. If I sell in a market. If I sell in a falling market. If I sell in a falling market, I wonder what happens. And that's how I came up with the whole strategy, 10 or 12 years ago. I wonder what happens if I simply sell in a falling market. So I had to differentiate price, which is the 5/8, from the market, which is the 2155. And just simply sell only in a falling market. And ideally never buy in a falling market. See? Just separate it out. Then I moved on and I realized that I can sort of measure this relatively, and I decided to use some oscillators. So I spent, I don't know, 2 or 3 years mastering oscillators. I used all kinds of oscillators and tweaked and customized and tested and measured and all this until it came down to my standard template includes a MACD. Okay? Now here's the interesting thing. The reason I have two oscillators, is the MACD represents overbought and oversold conditions for the market. Okay? And the stochastics represents overbought and oversold conditions for price. And once again, what you're trying to do is line up price action in the same direction as market forces. Isn't that clever? What a clever boy. So then I had to adjust the oscillators and customize them to give me the output that I'm looking for. So once you understand how the math works, you can adjust the standard settings to customize settings to give you the output you're looking for that you have. So therefore you have useful information. So if you look at my MACD settings, what are the most important numbers on the MACD settings? 2155. Well, Wayne, those are the same as the moving averages that you use to measure the direction and speed of the market. And then I say, well, right? And what are the key numbers I use in my stochastics to measure overbought and oversold conditions for price? 5 and the 8. Oh, snap, Wayne. Those are the same as the moving averages you use to measure overbought, speed and momentum of price. Uh-huh. My gosh, it's actually intelligent. Yeah. That's why it works. How cool, huh? Oh yeah, sure. Divergence is fine. Yeah. Yeah, you can use them for divergence. It's fine. Because what divergence is telling you is that let's say the market is falling. Let's say it's a bearish market. But let's say you had bullish divergence. Let's say this turned up here. You know what it's telling you? Bears are taking profit. Okay? Bears are taking profit, and the market now might still be bearish, but there's just a lot less bears than there used to be, which makes you vulnerable to bull coming in and reversing it. And that's why divergence works. So I actually put a whole, like, maybe a page or two in my book about that, what divergence means, why it happens. And a lot of it has to do with how far you are from the 200. So I think you could make an indicator, if you wanted to, that measured how far you were from the 200 EMA. So you could actually probably take a MACD and say, do a 21-200 EMA or MACD and measure, are you moving away from the 200 EMA, right? Is the 21 moving away from the 200, right, which is fair market value? Now, what does fair market value mean? Let's talk about that for a second, since I'm talking about moving averages. Fair market value means the bulls and bears agree. If price is up here, market's not bullish, it's not bearish, nobody knows what to do. See, down here, at least the market's bearish and everyone's selling. Up here, well, it could go up if the bulls take over, but the bears could resume trend. I don't know. I have no idea what's going on. But what happens, and let me ask you, like, so if the 21 is getting farther and farther and farther and farther away from fair market value, what do you do when you're on an unbelievably profitable trade? And all of a sudden you're up like 100 pips on a trade. Do you ever like freak out and you're like, oh, I gotta take profit. I gotta take profit. I gotta get my 100 pips. I gotta get my 100 pips, right? And all of a sudden every bone in your body says, get out. It's gonna come back. It's gone too far. You got a small fortune. Take profit. Take profit. Take profit. And you know you do it. Don't you turn your back on me. Right? And that's what happens. If you get too far from the 200 EMA, you just have to take profit because it's moved too far too fast. So I've never actually done this. Let's wonder if you could do that. 21,200. Let's see what 8 does. Okay, so what this is saying, okay, is that we're below the 200, and right now it's just starting to work its way away from the 200. The 21 now is just starting to expand out, which means it's bearish. Okay, does this mean it's bullish? No. It means bears are losing control. That's all. Cool. I hope that little diversion was helpful and interesting. So that's how I came up with all of that. So, right? What does it all mean, Basil? Well, that's what it means. Austin. Below the cloud cover, bearish. What do you think? Zip, zip, zip. You know these little dots, if price is below, you're bearish. Okay? Price is above the dot, you're bullish. So what this is saying is bear, 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 bull, 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 bear, 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 bear. Just if you want to know how to use PSAR. But it's lagging. Uh-huh. Another lagging indicator you can add. Beep, beep, boop, beep, 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 boop, boop, beep, bump. Yup. So what this is saying is we've made a lower high. You should expect a lower low. Beep. And that wick is wild, man. Holy smokes. Yeah, Eric asked about the zigzag. You know, do you customize the settings? And the answer is yes. So what I just did was default, but you can change the time frames to the ones that you like to trade. And then what you should do is adjust the sensitivity, because you can get it to that it's really measuring these slower moves, right? Versus just the giant move. So yeah, tweak with it, sure, absolutely. Just so you can get like the definition of peak and valley a little bit better. Okay. But like this is not very sensitive, and you could certainly have done this where you here, and it should have made a lower low, but then it didn't. It made a higher high, so then you should have bought here, but then it didn't go up. So this sensitivity just might be fine for you. Okay. I look at this, and I could certainly have got sucked into a reversal pattern that never produced. Bloody Kiwi. Let's look at Kiwi Yen. Okay. That's why I think, like going back to what I said on the Kiwi dollar, I think you need to start first and foremost with fundamental analysis. That's why I created that training course. Right? Oh, does everybody know that? I think so, right? You guys were asking for a 20 to 30 hour training course on fundamental analysis. I created that for you. I said it would be $1,000, but I convinced TradersWay.com to sponsor you. So instead of paying $1,000, what you can do is put $500 into a trading account and trade it at TradersWay, and then ask support for a coupon code that will take that $500 that you invested into your trading account, and it'll subtract it from the $1,000 fee for the training course. So now your training course is only $500. So here's the thought, guys. Why throw $500 away? Right? Why throw it away? So just pay $500 for the training course, pay $500 to open up a trading account at TradersWay, and you're good to go. So, oh, you guys, I sent out a bunch of emails. I think on Friday you might have gotten an email. Let me bring it up. I haven't been to the website in a while. Okay, here it is. So and by the way, you guys asked for this. That's the only reason I did it. Training.fxbootcamp.com. Okay, so you can click on it in various ways. Like I said, it's $1,000. It's $979. Or if you put $500 in a TradersWay account, they'll give you a coupon code to save $500. You see what I mean? So instead of putting $500 in my pocket, put it in a trading account and trade it and make money. I mean, that's fair, right? Yeah, I know. We got the kitty cat news. So training.fxbootcamp.com. Yeah, you got it. So anyways, you asked for it. Now you have it. And I set you up a $500 discount. Now, what more could you ask for, right? And those are the topics that you're going to learn about. There's going to be probably 24 hours of videos. So consider it an entire college course.
Month-on-month, 0.5% is 0.3 better than expected year-over-year, and 0.6% is 0.2 better than expected, and second quarter minus 0.5% on an annualized basis, 0.5 better than expected, though the first quarter revised lower to minus 0.8% from its first month-on-month growth in Canada GDP in 6 months.
All right. Yeah. Got what we wanted. Yeah, Bubba. Woo-wee. We were looking at it on a different one earlier. Hang on. Where was it? Must have been on the around the world. Around the world. There it is. Boo-wee. Boo-yah. Ha-ha. Hoo-ha. How do you like them apples? Very nice. Very nice. Well, cool. Around the world. Oh. Cool, man. I love it when it goes the way it's supposed to. But I don't know if that's all the time. So it's still got to eyeball this bottom, huh? I think we talked about that earlier today, didn't we? Coming down, retesting the weekly central. Very interesting. So yeah, I think the rest of the day, let's kind of do a wrap up. I think the rest of the day is going to come down to what the stock boys are going to want to do. And it'll be very interesting because I think it go either way, because if it comes down, if the stock market falls today, again, I think it's just normal rebalancing and adjustment. So for example, when you start the month, you might have to do some rebalancing, right? Like, did you notice that, like, wow, I said like a lot. I was just in California, so those dudes. Like, dude. So anyways, did you notice that Friday ended down? Well, that shows me that at the end of the month, portfolio managers had to rebalance because of various things, because of their disclosure documents to their investors, and sometimes that includes how much they're allowed to invest on a percentage basis on any individual trading idea, like a particular stock. It also may have to adjust the portfolio based on how much volatility hit the portfolio over the last reporting period. Right? You know what I mean? So they had to rebalance and make some changes and get out of some things. And who knows, today maybe they buy back into new equities or back into the same equities. But Friday, the last day of the month is very often, right? Is very, very often a down day, just because of what they're forced to do in their risk management, profiles with they promise their investors. So today, I think, could be interesting whether they want to start out September with guns blazing. But this September is not your average September, is it? What's the big question mark of the month? What could be driving risk on or risk off? Yeah, the September 17th. Now Marcia says China, but see what I'm trying to say, and I don't, maybe I'm not saying it the right way. China, the China issue has to do with the Fed raising interest rates soon. The policy and potential policy change in the United States is what's causing the China problem. Okay, like China has been in their economic situation for years. I mean, how many times have they lowered their interest rates? How many times have they adjusted RRR? How long has industrial production and capacity utilization been falling? I mean, we track it day after day after day, and the numbers have been coming in, 51, then 50.5, and then 50.1, and then all of a sudden, boom, contraction, 49.8, 45. And I mean, it's been going on. The trend has been going on for years. It's not a shock, right? Not a shock whatsoever. And then suddenly, out of the blue, we get to the point where sometime very soon, and impossibly September, suddenly, China, all hell breaks loose, devaluation of the currency, breaking away from the peg. Well, that has 100% to do with the Fed and has nothing to do whatsoever with the Chinese economy. That's the interesting thing. And we talked about it, like, this is what's interesting. Let's go to this. By the way, look at it come down. Wow. Okay. So this currency, let's pick a cleaner chart, maybe. This one will do. Let's go weekly. Okay. This is China's. This is the renminbi. Oh, this is a binary option. Hang on. This doesn't go back far enough. Oops. Around the world, where's my USD yen? Come on. Oh, there it is right there. Okay. This is the renminbi. This is the... Now, of course, it's not. This is the USD yen. But you could substitute the two, and there'd be very little difference. Okay? Because this is the devaluation of the Japanese yen. Okay? So the yen has been devalued, and the dollar's been going up, but the CNY, or the RMB, the Chinese currency, is pegged to the US dollar. So that is the value of the Chinese currency going up relative to its largest trading competitor. And what happens when the Fed decides to raise interest rates? This goes up even faster or even farther. And how long is the Fed going to raise interest rates? It could be 5 or 6 or 7 years. So they have to break, CNY has to break this and devalue just to stay in competition with the Japanese. So everything that's happening now in China is predictable and boring. But of course, everybody's freaking out. Oh my God, this guy is falling. This guy, dude, whatever. So anyways, it's only money, right? That's what I love to say. It's only money. That's what we do. Well, cool. So imagine now if the People's Bank of China has to adjust their portfolio, well, what about a hedge fund manager? What about a mutual fund manager? What about a money market manager? What about a chief financial officer at a multinational corporation? So I was talking to one of my friends the other day, and he's in a solar company, I guess I should say. He's in a solar company, and we were talking, I don't want to say which one, but they had, let's just say they had a lot of business in Japan. I won't say percentage-wise, but they were killing it in Japan. And then they find out orders are going to go to 0 this year. And I said, yeah, that's predictable. The Japanese can't afford it. I'm like, you need a foreign exchange trader. I could have told you that. Because in 1 year, we went from 100 to 125. And the year before, we went from 75 to 100. The value of the Japanese yen is tanking from quantitative easing. And there's no way they can afford to buy foreign goods. They can't afford it, especially from the United States, from a currency that's appreciating rapidly. And the Japanese currency is depreciating rapidly. And the Japanese, since they have no energy of their own, has to import energy to the tune of 100% GDP just for energy. Holy smokes. Yeah. So I said, what you need, if you want to make significant increased sales for next year, is you need a foreign exchange trader to tell you who's on the winning side of all of this so that you can go to that market and sell to them. Because it's only money, honey. It's only money. Hey, peace on earth. May the pips be with you. May your profits be above average. And I'm glad you guys are showing signs of success. Your happiness, your success, my happiness, and my success. So thank you for being a client of TradersWay. And and that training course. Let me bring that up again. I went to considerable amount of effort to do this for you since you guys asked for it. So like I said, there's approximately 24 hours of videos. So you're going to learn about the financial markets and players in the financial markets. You're going to learn about what a bank does. In fact, you'll learn how to manage a small bank and make it decisions so that your balance sheet will balance, right? Your liabilities, your assets, and your bank equity all have to balance. And then once you understand commercial banking, you'll understand a lot better central banking, what central banks do, the history of central banking, the history of the Fed, how the Fed works, what the FOMC does, what the Board of Governors does, what FOMC meetings are. Specifically, I'll walk you through what a meeting is, in the order of an agenda of an FOMC meeting. Who does what, who presents what happens next, right? The difference between a blue book, a beige book, or a green book, and all these different things, all the way through microeconomics, fundamental analysis, currency correlation, advanced strategies. I'm going to take you through inflationary indicators, employment indicators, industry indicators, consumer indicators, and wrap it all together and how you can apply this to the foreign exchange market. All for you, Bubba. And found a way to get it to you for half price. So I love you. I want you to succeed. I'm glad you're working your butt off. So just trying my best to give you what you need. I'll see you tomorrow. First time, Mark? Right on, Marky. Welcome to the team. So again, training.fxbootcamp.com. Cheers.